At the same time, stock market indexes are enjoying a near historic run back to all-time highs. The swap market has gone in the complete contrary direction. In fact, this past week, coming within a very small amount of hitting new record negative lows. This is no longer just some minor disagreement about a few proportions. These two markets have come to very polar opposite positions, starting with what happened in April and what it really meant. Now, everyone knows the stock market. We're all taught from the very beginning it is the key financial signal, the greatest discounting mechanism of fundamental information human beings have ever come up with. Yet hardly anyone has heard of interest rate swaps, and even among the few who have, fewer still realize what they really are and how essential they've long since become to the operation of pretty much everything. So this is one for the books. The higher stocks go, the more the general public believes the narrative priced into the New York Stock Exchange and the NASDAQ, because for everyone in the public, what else is there? Meanwhile, as equities rip, the stock market keeps doubling and tripling down against that very narrative. And the other one too, the inflation one, the one posited by the Federal Reserve. You see, a key reason behind these negative swaps prices and the record negative swap spreads is how intensely the market is also betting against Jay Powell's inflation view. But why? What is this disagreement between what are supposed to be two gigantic marketplaces really about? Interest rates are at the heart of it, sure, but it really gets down to differences in conclusions about what happened in April, why it happened in April, and what it ultimately means moving forward. Now, you already know about stocks and what equity indexes have been doing the last month. You hardly need me to tell you about it. Share prices, at least share indexes, they're completely on fire. In fact, this headline from CNBC on Thursday is a pretty good summation. S&P 500 rises to new closing record, boosted by solid earnings and U.S. economic data. Quoting the article, stocks rose on Thursday, buoyed by fresh economic data reports, along with a slew of corporate earnings releases. Quarterly earnings reports released this week have exceeded Wall Street's expectations, fueling investor confidence. Around 50 of the S&P 500's components have reported thus far, with 88% of those exceeding analyst expectations, FactSet data shows. And key data releases on Thursday reflected strength in the U.S. economy. And they were talking about initial jobless claims along with retail sales. And we can disagree and quibble about what all those actually meant, but the narrative is there. The U.S. economy is just fine, no thanks to what happened in April. In fact, April was something of nothing more than a scare. So that's the narrative and interpretation according to the stock market. Nothing bad came of April. It was a minor scare and nothing more. The world can go back to being Goldilocks, especially if the Fed does start cutting rates just for the hell of it, apparently. It's a very vastly different story from the swap market perspective. From this one, April was no one-off. It was confirmation. That's why spreads plunged and then never came back in the 3 months since then. Even though the outbreak of deflation itself only lasted about a week, maybe a little more in certain patches, that it got to be that much to begin with and then went that far was proof of everything the swap market had been pricing more confidently up until April, why spreads have been moving decisively lower for years leading up to now. Since the deflation in April really was that bad, naturally the swap market took it as confirmation for what swaps are already pricing. That is, interest rates are going to go a lot lower and then stay there a lot longer. And what happened in April simply goes along with how that could possibly take place. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with monetary metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. Now, since most people are not familiar with the swap market, a negative swap spread is a sign that things are not good, they're heading in the wrong direction. It's when market participants are willing to accept a lower fixed payment from the interest rate swap than they would get for owning the same maturity US Treasury. That is the spread that we're talking about in a swap spread. And the only reasons they would do that are, one, problems in the monetary system with repo and balance sheet capacity among dealers that might get difficult to engage in a free money arbitrage to take advantage of that difference, because it really isn't supposed to happen. You would never expect that financial counterparties would accept a lower payment from an interest rate swap than they could get from a US Treasury at the same maturity. But the other thing is, those who are accepting fixed swap payments that low think that the swap payments themselves are already overvalued, even though they're below US Treasury yields. And why would they be overvalued? Because they think short-term interest rates are going to go down by a lot in the future. In many ways, it's the swap market's way of saying bull steepening, relative value and opportunity, more so at the front end of the curve. We also have to keep in mind that the Federal Reserve and its interference in the front end of the curve is a key component at times in swap market pricing too. If, for example, just spitballing here, central bank officials are convinced inflation risks are very high, therefore they're going to be less willing to lower short-term rates in the future, that relative hawkishness will impact the forward rate curve, making it flatter than it otherwise would be. And since forward rate curves are what interest rate swap contracts use to price the fixed yield for the contract, that means this Fed interference goes into the pricing of the swap. So if the forward rate curve is flatter, meaning less inverted as it is now, because the Fed doesn't know what inflation is or where it comes from, and the market knows this and believes policymakers are insane in chasing inflation ghosts that aren't really real, that would be even greater opportunity to go long fixed in a swap, driving down the spread to the nominal US Treasury. In this instance, the more negative the swap spread, the more this critical market is betting directly against Jay Powell and the FOMC and its inflation narrative. Now, I know all this is very confusing to most people, which is why Eurodollar University is here to begin with, is why I'm bringing it to you here on YouTube. But there's so much more to this, the swap market story, as well as the entire Eurodollar story itself. We've got memberships on sale right now, and our memberships are where you get the basic information on interest rate swaps. I've got a 4-part basic series just on those, but there's also a ton more on the background for the Eurodollar system, how modern ledger money works, or how it's supposed to work, including the supremacy of collateral, what it all means, and why this stuff exists. You can check out our anniversary sale that's ongoing and all the membership benefits at our website, eurodollar.university. Now, the short version of swap spreads is really pretty simple. When they go down, meaning in this case more negative, when they get more deeply negative, especially down to record negatives, what that means is the swap market is increasingly confident that interest rates are going to go down and then stay there for a long time. That's what longer dated, longer maturity contracts in the interest rate swap market is saying. Not just go down, but also stay there. Now, while that's helpful and tells us a lot that's very important about these financial characteristics of the future and the probabilities associated with them, we still have to fill in all the blanks. If that's what the market is saying and we should pay attention to this market, then how do we get there? What are the actual steps that we take to get there? And this is where I think April really comes into it. It's also something that I went over at our webinar just a few weeks ago. I showed you why the swap market is so valuable and how it has been near spot on during these confusing post-pandemic, forgot how to grow, Fed constantly talking about inflation, 2020s. And by the way, a replay of that webinar is still available. I put a link in the description just in case you want to see it. But the upshot is that for our purposes here, the swap spreads plunged in April and then never came back. Not only did they not come back, they're actually moving lower again. So looking at the 5-year maturity, which has more of a short-run influence, less purely long-term, There was, of course, the big plunge in spreads in April, like everything else, including stock market. And like the stock market, the 5-year swap spread at least started to come back in April and early May, which meant that the market was saying, okay, maybe not so bad. But swap spreads never really went all that far, and then they began to top out in mid-May, which is relatively quickly, and went sideways from there through mid-June, but now have made a pretty clear move downwards ever since around June 25th. Not a good sign going back toward the April lows. The real key one, though, that's the 10-year maturity. And this past week, the 10-year maturity, the swap spread there, came within a very, very small amount of setting a new record low, even further negative than it had been way back on April 8th in the thick of all of this liquidation and deflationary business. Like the 5-year maturity, there was an initial decompression in the 10-year spreads that became a little bit less negative, but like the 5-year, in fact, more than the 5-year, it never really got all that far. At its least negative point on May 12th, the 10-year spread was still right around minus 50 basis points, which would have been very nearly a record low before April. That's how little there was of a retracement in the 10-year spread. So the 10-year spread, it stayed low, then it turned around pretty quickly, and ever since around June 12th, it's been moving steadily lower again. In fact, to the point that, as I just mentioned, last Tuesday, it came within a couple fractions of a basis point, really 2 pips of equaling that April low. So you should be asking yourself this question: how can that be? How can swap spreads be as negative as they had been during the first week in April when the world seemed to be falling off a cliff and falling apart? How can the swap market be back down to those levels? After all, stocks are soaring, or some of them anyway. You got new record highs for the S&P 500 and the NASDAQ. So before we answer those questions, though, I do want to note the 30-year spread, because that's an important maturity too, especially the ultra-long dates that associate with, therefore, longer-term perspectives. Like the other maturities I've highlighted here, there was the big plunge in April, but the 30-year maturity tends to be steadier, more on a trend, more aligned with its trend than its shorter-term contracted cousins. So yes, there's the big plunge in April, but then it just kind of goes back down to its downward trend that had been on leading up to this year. And being close to that trend has left it closer to the record lows in April than not. So still consistent with the overall swap market, which is whatever happened in April represented a ratcheting down in these conditions, but also a ratcheting up in confidence over the interpretation of those conditions. So what that tells us, the consistency in the swap market and these spreads, is that for the swap market, April was no one-off, or as most people are now thinking, a false alarm. That's why equities seem to have completely forgotten about it that ever happened. The narrative on Wall Street is that markets overreacted to tariffs and trade wars. We all dodged a bullet that maybe wasn't that great of a threat to begin with. The economy continues to be resilient, even solid, as Jay Powell likes to say. Now, we have to keep in mind, though, the stock market has almost nothing to do with the economy, apart from the stock investors inventing and buying narratives surrounding it. But that's not the case in the swap market. In fact, the most compelling aspect of all of this for the swap market, and the most damning aspect, was the interplay between macro and money. In other words, like last August, though in a bigger, broader way, the system nearly melted down, not over tariffs, but the possibility a tariff system would push a fragile economy right over the edge. And that possibility even sent stocks into a tailspin that they only got out of when tariffs were delayed, but the tariffs were never eliminated. But anyway, this isn't about trade wars. That potential downshift in the real economy, though trade wars represented, unleashed a torrent of monetary deflation in critical parts of the Eurodollar system. We know what happened in repo, for example. First of all, by the basis trade reversal. That wasn't about treasury market liquidity. It was bad deflationary, illiquid conditions in the vastly more important repo system that triggered the treasury selling in the first place. And the fact that the April deflationary outbreak triggered a basis trade reversal was already an indication of how bad it got to be right from the get-go. But we also have hard data from the Treasury Department, which shows basically the same thing with a couple of crucial added details. The tick series showed a huge jump in resale activity, or U.S. banks lending cash on collateral to offshore parties. And I went over this in a previous video a little while ago. Tick also showed who it was that were borrowing all of those funds, or at least what kind of parties those were that were doing all the borrowing. They were shadow banks. And as I pointed out in that prior video, The shocking part was that dealers were willing to accept collateral other than treasury bills and treasuries, meaning they were taking crap collateral during a meltdown. That would not have been by choice, showing just how serious dealers were taking the whole thing then, that they must have thought if they didn't bite the bullet and take the crap collateral, the shadow banking system could have really spiraled into something really, really bad, more than it was. In other words, the key funding market for the entire world broke down, leading to a spiral that got so bad, US regulated banks bailed everything out. And as spreads blew out in the credit market, the basis trade, copper got liquidated, oil got liquidated. It really was on the verge of crisis proportions. And all because of macro fears, not tariffs, macro fears. Macro fears triggered the fragility in the monetary system the swap market has been pricing for years leading up to this. So if the macro risks haven't actually diminished, then everything that happened in April, if not more, remains right there on the table. And if it's all right there on the table, that would certainly lead to a future where short-term rates are going to go a lot lower for a ton longer. That's the divide. The stock market is looking at what happened in April and saying it was a scare, it was an overreaction, it was no big deal, it was just a one-off at the most. The swap market looked at April and said, there was a lot of serious stuff that happened, which confirmed our view of the fragility, and a fragility that was triggered by concerns over a macroeconomy that hasn't gotten better since April, was never strong and resilient to begin with, and the risk of the macroeconomy doing the same thing moving forward haven't been eliminated. If anything, they have been strengthened. I mean, after all, when is the last time anyone in the stock market mentioned any of these very real deflationary monetary problems, or even knows anything about them, or that any of this actually exists? Meanwhile, for swaps, they've been pricing these kinds of possibilities for these very same reasons for several years already. Therefore, naturally, it took April as confirmation that these scenarios weren't actually just risk, they were reality. And that didn't just magically go away over the last 3 months because Jay Powell can't stop talking about inflation risks. So what happens if the last payroll report, for example, really was a warning, or all the details that went along with it, the unusual weakness that we've seen in earnings as well as spending and a whole bunch of others? Where does everything go if the economy shows more and clearer signs of deterioration moving forward? The stock market doesn't have to care, but shadow banks certainly do, and so does the repo system. Therefore, money dealers as well. The money dealers who are a big part of interest rate swaps and interest rate swap spreads. Only this next time, if there is one, maybe the dealers don't accept the crap collateral. Maybe they don't put up the cash to bail out the entire offshore shadow system. From the swap market's perspective, April's deflationary flash was validation, certainly dead against the inflation the FOMC keeps talking about. And so swap spreads aren't just hanging around the recent lows, they're actually and actively retesting them. So while we may not exactly know what it is that has the swap market so deeply pessimistic, so on edge, why the market is so certain that interest rates are going to go lower for a lot longer, ever since April, it's much less of a guess, isn't it? It's the same reason why the US banking system and banks around the rest of the world keep buying tons of government bonds. If inflation, like Jay Powell says, was the greatest risk, that's the last thing they would be doing. Went over the details in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's sale. Huge thanks to Eurodollar University members and subscribers. And until next time, take care.